In this video, traders, we've got 3 ways to prevent buying the pullback too early, something that traders do all the time. Stay tuned. Hey guys, warm welcome to you. Thank you for joining me. Alright, so as traders, we can be buying this pullback too early, too soon. We end up getting stopped out. It's frustrating. You know, the market's driving hard. We've been waiting patiently for the pullback. The pullback comes. We think it's going to stall. We think it's about to turn. And while you're kind of developing your price action skills as well, because there's nothing better than being able to see it, you know, from a pure price action perspective. But while we're timing that, the market's coming back. It's starting to rotate. You think it's going to go. You go long, and it goes deeper. It stops you out. Then it finally goes super frustrating. So I've covered things like this before, but I don't think you can have too many ways and choices to use to try to time that pullback. You know, you might pick one of these, you might pick some of them, you might discard them and look at other ones when I've done other videos about this, because it's such a fundamental part of all traders' setups and strategies. Unless you are a pure mean reversion trader, you're not even interested at all in trend trading, you're going to be buying a pullback at some point with your intraday trading, with your swing trading. So this works on both ways. So this is purely a binary event. Okay, so the issue we have when buying pullback sometimes is that, oh, do we buy now? Do we not? We're leaving the decision-making process up to us. Now, in the perfect world, that's the best way of doing it, using your intuition and your gut and your trading experience to know if it's a shallow pullback, if it's going to be deeper, if it's not at all, is most likely the best thing to do. But I get it that for many traders who are, you know, coming up through the ranks, so to speak, who are learning the ropes, who are putting the screen time in, you want to have some kind of literal yes or no entry point, and then later on you add intuition into that process. I've talked a lot about intuition. There's going to be so many more videos about that coming up, guys, so make sure you're subscribed if you're interested in kind of developing that side of things, because I'm a big advocate of that from a trading perspective. It's hard to quantify sometimes, but anyway, so if we start off by this and we go, right, what is the binary event that has to happen for you to pull the trigger on a long trade when we've pulled back after a drive higher? Okay, so the first one is this, and that's using an oscillator. Oscillators, you could use stochastic, RSI, CCI, but just pick one. Don't chop and change around. They're all giving you pretty much similar readings. Go to stochastic, nice and easy to read. RSI, nice and easy to read. So really, you're waiting until the stochastic goes into oversold territory, which is down here, and then you're buying. Or you're waiting for it to go into oversold territory and come back up, back out of oversold territory, then you're buying. Simple binary event. Price moves up, price moves down. If it doesn't come into oversold territory, you don't buy it. Now, you're going to have to be on the right time frame for this, because if you are on a higher time frame like a daily, you're probably never going to get into oversold territory. So if you're in a swing trader who's looking for a trader of multiple days, multiple weeks, you might have to bring that down to something like a 15-minute or a 60-minute and see it go oversold on that lower time frame before you pull the trigger. Same as if you're day trading. If you're day trading off a 5-minute chart, you're probably going to want to see that off a 1-minute chart or something like that. So waiting for it to go into an oversold condition, or as it comes out of oversold condition. All right, guys, number 2 is the close above prior high. So what is this? So very simple. Again, a binary type of event, either does or it doesn't. Market's pulling back, market's pulling back. Whatever time frame you're now on, if you don't get a break of the high and a close above the high, so let's say I kind of zoomed in on these candles here to save me drawing all of those, and these are the important ones here. Down candle, down candle, down candle. You don't buy until you get the close above the high. So there was the high on that candle. There's your close. Now you're in. So whatever time frame you're trading on, same kind of thing again. You're waiting for that close. Once it's there, very simple. You're executing the long trade. You know, you're not having to. And if it kind of V-shape reverse and keeps going, you're not in it. If it starts to reverse, then great, you're in it. Now, obvious place for the stop is going to be under the low of the move. So again, very easy way to frame the trade. Do I recommend this on a really low time frame, like a 1 minute? Probably not, because of the noise. If you can pull out a bit to a 5, great. And obviously if you're swing trading, you're looking for a daily chart anyway. Okay, the third thing, guys, is a moving average. So this requires a little bit of adjustment depending on the type of conditions you're in. If you're in a very strong trend, then you're going to have to have a quicker moving average, like a 10 period. If you're in a kind of normal trend, a 20 period will be fine. If you're in a really aggressive trend, then going for a 5 or something, that's super rare. So the example here is that it pushes up, and the idea is you don't buy until price has crossed the level. Now, with all these things, you may well miss, apart from this one, you may well, with these two specifically, you may well miss the trade. It may not go to oversold territory, it may just go to the upside, it may not even touch one of your moving averages. But the idea is that you at least have metrics to work on, or work from, should I say, and you can say, right, it touched it, 7% of the time, the other times it didn't, fine. You have a actual criteria. You're not shooting from the hip, you're not guessing. You have some binary event that's yes or no, a simplified execution process. So the market comes back, it touches your 20 period moving average, now you can initiate a pullback buy. It touches your 10 period moving average, now you can initiate a pullback buy. And you might want to adjust that depending on the angle of the trend. You can use linear regression or whatever it may be, a trend line on that. So these things, guys, they're all very simple to execute. There's nothing revolutionary here, but sometimes putting these very strict rules in means that you don't necessarily have to trade like this forever. But if you find yourself being too early on pullbacks, if you find yourself buying and it goes against you, end up getting stopped out, then it finally goes, then maybe something like this is a good way to prove to you that patience pays off with this setup and strategy. It proves to you that actually waiting for a specific event to occur, for a specific price or specific indicator, whatever it may be to occur, means that, okay, I don't have to jump the gun too early. Look, the proof is in the pudding. These are starting to become more profitable trades, this, that, the other. So have a think about that, guys. If you've got any more you want to add to it, then please do. I've done others. I've covered other ways of kind of entering this pullback trade from a swing trading perspective and a day trading perspective before, so go and check them out if you're interested in that. If you like this kind of stuff, you're interested in kind of tactical tips, if you like, for want of a better word, I don't really like using that word, but tactical ways to perhaps take one or two and implement it into your trading, hopefully improve your trading, then you're on the right channel, and a subscription is well worth your time, if I do say so myself. Thank you, guys. Appreciate your support. Keep your risk managed whatever you do. Bye-bye.